When foreign companies consider establishing a branch in Denmark, it is essential to understand both the tax benefits and the broader implications that accompany this choice, as these factors will directly influence the overall attractiveness and long-term viability of the Danish market entry. Denmark offers a relatively straightforward corporate tax regime with a flat corporate income tax rate that is competitive within the European context, and this rate applies to the Danish source profits of a foreign branch in the same way it would apply to a locally incorporated subsidiary. From the outset, one of the primary advantages of using a branch structure is that it is not a separate legal entity from the foreign head office. This can simplify internal governance, reduce formal capital requirements, and in some cases allow the foreign company to offset Danish branch losses against taxable profits in the home jurisdiction, subject to the tax rules of that jurisdiction. For many groups, this potential for cross-border loss utilization in the early years can be a significant benefit, especially when the Danish operation is in a growth or investment phase and not yet profitable. At the same time, Denmark's extensive network of double tax treaties, combined with its alignment with OECD principles, helps to mitigate the risk of double taxation on branch profits, while the country's stable legislation and predictable tax administration offer an environment in which foreign investors can plan with a high degree of certainty. However, these benefits must be weighed against the compliance obligations and transparency requirements that come with operating in Denmark. A Danish branch is subject to Danish tax filing and bookkeeping rules, including the preparation of annual financial statements for the branch and maintenance of adequate documentation to substantiate the allocation of income and expenses between the head office and the Danish operation. Transfer pricing rules apply to branches in much the same way they apply to subsidiaries, requiring that intra-group transactions and internal dealings are priced at arm's length, often supported by robust transfer pricing documentation. Failure to meet these standards can lead to adjustments by the Danish tax agency, potential double taxation, and interest or penalties. Another important implication is the concept of a permanent establishment. By registering a branch and conducting business through a fixed place in Denmark, the foreign company is effectively recognizing that it has a taxable presence there, which obliges it to pay Danish tax on profits attributable to that presence. This requires a careful analysis of functions, assets, and risks carried out in Denmark, as these will determine the profit allocation under OECD-based principles. In practice, this means that foreign groups must consider how the Danish branch fits into their global value chain, how management and key decision-making are structured, and whether the branch is performing routine or more entrepreneurial activities. Denmark's VAT and payroll tax environment also plays a critical role. Branches that supply goods or services in Denmark will typically need to register for VAT, charge Danish VAT on taxable supplies, and comply with local invoicing and reporting standards. On the employment side, hiring staff in Denmark triggers obligations around Danish payroll taxes, social security contributions, where applicable, and adherence to Danish employment and labour law, including collective agreements in some sectors. While these obligations are not unique to branches, the foreign head office must be prepared to manage them or partner with local advisors or service providers. From a strategic perspective, it is also worth comparing the branch model with a Danish subsidiary. A subsidiary, being a separate legal entity, can sometimes offer clearer limitation of legal liability, easier participation in certain local incentive schemes, and a more familiar structure for Danish business partners and banks. By contrast, a branch can be more flexible to establish and unwind, and can avoid issues such as withholding tax on dividends, as profits are not formally distributed, but rather treated as part of the head office's overall results. However, profit repatriation from a branch may still raise tax questions in the home country. and the foreign company should examine how Danish branch profits are treated under its domestic tax law, including any foreign tax credit or exemption regimes. Additionally, Denmark's robust anti-avoidance framework, including general anti-avoidance rules and specific provisions targeting hybrid mismatches and interest limitation, means that foreign groups should not view the branch structure as a vehicle for aggressive tax planning. Instead, the Danish authorities expect a clear business rationale for the presence in Denmark, supported by substance in terms of local operations, employees, and decision-making. Over time, as the Danish business grows, some companies choose to convert a branch into a subsidiary to better reflect the scale and independence of the local operation, or to facilitate local equity participation, financing, or potential divestment. In designing an optimal structure, leadership teams should conduct a holistic assessment integrating corporate tax, VAT, transfer pricing, legal liability, regulatory licensing, HR, and operational considerations. Early engagement with Danish tax advisors and, where appropriate, dialogue with the Danish tax agency can help to clarify expectations, obtain certainty on complex issues, and reduce the risk of future disputes. In conclusion, establishing a foreign company branch in Denmark can offer meaningful tax and operational benefits, including potential loss utilization, a competitive and predictable tax regime, and access to a sophisticated, stable market at the heart of the Nordic region. At the same time, it brings with it clear responsibilities in terms of compliance, documentation, and alignment with international tax standards. Companies that invest the time up front to understand these dynamics, design the right structure, and implement robust governance and reporting processes are best positioned to capture the advantages of a Danish presence while managing their tax risk in a disciplined, sustainable way.